Thanks, Teresa, and thanks everybody for making the time to come back for day 2. I feel honored that you came back and didn't skip today, so I appreciate that. Looks like people are still kind of connecting on audio, so we'll give it just a few minutes to make sure folks can get in and hear everything. I'd love to hear what y'all are up to and get some feedback from yesterday. Was there anything that was particularly helpful to you yesterday, or something that you think really resonated or stuck with you, or that you'll use with survivors moving forward from yesterday? I'd love to hear about that in the chat, or you can unmute yourself. They're a small enough group that we can hear each other's voices if that works for everybody. And did you see the note here from Victoria, Teresa? Fantastic. Any feedback from yesterday or anything that folks felt like they were going to use going forward? I'll also make sure that you all have a link. This is a link to our webpage, which it links to some videos, as well as the calculation sheets that I shared with you yesterday on the spending leak and the budget sheet. Those can all be found at the link provided to our website. So you're welcome to go there and check that out. Dawn says, morning, I spent the afternoon looking at the website and got great information. Fantastic. Yeah, please do check out our website. You can get the curriculum on our website as well as the AllState Foundation's website. And you can go to both of those. The AllState Foundation's got good stuff there. So please take some time to take a look at that. So thanks so much. Thanks, Molly, for your feedback. Cancel subscription to food delivery, reviewed my budget and bank statements. That's amazing. And I feel bad now. Your family's probably going to be so mad at me, Clover, that the meal subscription's been canceled. But I'm excited that people, my hope is that people feel like they're more in control of their money, and not that it's controlling them. That's not what we want. We want you to feel like you're in control of it and you're making those decisions. So yes, please come over to my house. I love to host. I'd love to do that. You're welcome here anytime. I often do girls' nights, so please do come over. That'd be amazing. Fantastic. Okay, I think it looks like everybody's signed in, and so I think I'm going to go ahead and launch my screen here. Forgive me just one. Does anybody ever have trouble where your cursor gets lost on the page? Okay, that's what's happening. Okay, I'm going to share this. Maybe. See if that works. My cursor is not working. You don't see the PowerPoint, do you? Oh, wait, there we go. Share. Now you see it, correct? Fantastic. Okay, so module 3, as I mentioned yesterday, is we're going to talk about sort of credit, how credit works, and how you can what you can do to improve your credit and improve those you work with. But also, I think it's just helpful to kind of know how credit scores are formulated, because it's a bit of a mystery, and it has been kept a bit of a mystery for a while. And we'll talk a little bit about that as well. So we're going to talk about reviewing your credit score, understanding it, and how to improve it, and a little bit on bankruptcy we'll touch on. Feel free, if there's any questions along the way, you can type it in chat. I'll try really hard to pay attention to it. You can try to raise your hand. It should pop up on my screen if you raise your hand. Or again, we're a small enough group. I feel like we can probably have you unmute and ask the question if you're comfortable with it. So whatever your preference is. I'll make some things smaller over on my end so I can see everybody's faces that have cameras on. Okay, so just a little bit of reflection, sort of like we did yesterday. If you would type in the chat or unmute yourself. On a scale of 1 to 10, how well do you feel like you understand your credit report? 10 being, I got it, I could work for Experian if I had to. 1 being credit score, huh? So how well do you feel like you understand your credit report and score? Okay, mid to ups, good job, awesome. Great. This is your report, by the way. How well do you understand your report? All the things that are listed on your credit report. Okay, got it. How do you know what your credit score is? So the report is all the things that are on your credit history. The score is the number that is generated based on those things. Do you know your credit score? Okay, gotcha. So it sounds like most folks do. Little few don't, that's fine. And do you know what and where you were taught about credit? Who taught you how credit works? Where did you learn that? Self-taught, learned along the way, School of Hard Knocks, right? Yep, took weekly, oops, that went too fast. Took weekly courses, I think it was. Self as an adult, working in finance. Oh, great. Mother, husband, learned by life lessons, working, fantastic credit union. Great, great, great. So it sounds like we got some that had sort of more formal education around it. We had some that just learned along the way from other people. They learned by making mistakes, which is how a lot of us have learned that, right? So, okay, fantastic. That's helpful to know where we're at with everybody. So let's talk about what is in your credit report. Why it's important to even think about good credit. And it's important to understand that it allows you to obtain loans and credit cards with the best interest rates, and can improve your ability to even do things like rent an apartment or buy insurance coverage, or even certain jobs may require a good credit score. If part of your job is working with money or having access to a company credit card, then that they can ask for these kinds of things. So that's important to understand, that it's even just beyond borrowing money and interest rates, that actually, if you have a poor credit report or score, that it can affect your ability to rent an apartment or even and buy insurance coverage. Landlords and insurance companies and some employers can have access. They have to ask it of you. They can't just access it without telling you, but they can access things like your personal information if you allow them to. They can view payment history, past lawsuits against you, bankruptcies, and how often you've applied for credit. And that's usually part of a release for employment. They would ask those kinds of things. So your credit score shows whether or not you've paid your debts on time, how much you owe to creditors as well, and any unpaid loans will also show on a credit report that you pull. So here's an example of understanding how important a good credit score does affect things like borrowing money. So here's a chart that shows somebody borrowing $200,000 for a house mortgage. Somebody with a good credit score, and a reminder here is that the higher the score, the better the credit. You're considered good risk or low risk if you have a high credit score. It caps out at 850. So somebody with a good credit score, you see here, could get an interest rate on a home mortgage, $200,000 for 3.243%. An average monthly payment, this would be like on a 30-year fixed, would be about $870. That's not with escrow and all the other stuff, but just on the loan itself. Versus that here at the bottom, somebody, and that's not a huge difference. You know, you see that there's just a little over, maybe close to 150 point difference, but somebody with a 620 score at the bottom would get an interest rate that is about 1.5 points higher. So it doesn't seem like a lot, 4.8%. But this person's paying $200 more a month just in interest rate increases than the person with a great credit score. So $200 a month, that's $2,400 a year, $2,400 more they're going to pay per year in just interest for having a lower or poor credit score versus somebody who has a better credit score. So money itself, it makes is more expensive to borrow when somebody has a low or poor credit score. So let's take a look at what it would be for a new car. So here's somebody borrows $20,000 to buy a new car. Somebody with a 750 plus credit score maybe gets an interest rate of 6.36%. That car in the end, if you financed it out, would be about $2,300 is what you'd pay for a $20,000 car. So about a little over 3,400 would be an interest rate versus somebody with a very low score of 450 or under. They're probably not going to get one, but if somebody's at 451 to 599, they're going to get a really high, what I would consider almost predatory in nature interest rate. They're happy to finance a car, but it's going to be at 17.26%. And that person at the end of the time, at the end of the paying off that car, will have paid almost $10,000 more for a $20,000 car just in interest rates. Think if you could have actually bought a $30,000 car. So just in interest rates, it's going to cost that person more to borrow that money because their credit score is low. So some things to understand about pulling your credit score that might be helpful to know. Checking or pulling your own credit score or report does not hurt or lower your credit rating. This is what's called a self-inquiry. That's you pulling your own copy of your credit report or score. Credit inquiries made by companies checking your report to send you pre-approved offers do not count either. So that self-inquiry doesn't count against you or negatively impact you, as well as what they call a soft hit. So let me give you an example. Visa will ask TransUnion, which is one of there's 3 credit bureaus, will ask TransUnion, send us everybody with a credit score between 650 and 700. Experian or TransUnion pulls that stack of people with their addresses, sends it over to Visa. Visa turns around and sends those people an offer for a new credit card based on what they already know, which is your credit scores between 650 and 700. So when you get credit card offers in the mail, it's not by chance. You didn't get the same offer as your neighbor. You got that offer because they asked Experian for your criteria and you met it and you got that offer. Your neighbor got a different offer because their credit score is higher or lower. So it's important to note, so that's called a soft hit. You didn't ask for it. You didn't ask for the inquiry. You didn't approve the inquiry, but Visa provided it, right? So that's called a soft hit, does not negatively impact you. However, when you accept that offer from Visa and the credit card company or lender pulls your actual full credit report or does a more thorough check and now has extended a line of credit to you, that does count against you. On average, each inquiry can lower your score by 5 points. So every time you open up a new account, Target, Best Buy, Visa, a Walmart card, whatever that is, every time you open a new line of credit, go buy a car, you on average will drop your credit score by 5 points. However, there's some exceptions in there. The FICO system, which is the credit scoring system, allows for multiple inquiries within a 14-day period for a similar purchase, for a same purchase. So if you're going to go buy a car and you want to go shop rates, you can do that within a 2-week period. And it will show as one inquiry and not multiple five different inquiries from 5 different banks. So that you can rate shop. Now, dropping your score by 5 points is not a big deal if you're doing it once every 6 months or so, because every time you make your payment then to that company, so you go take out a Target card and they do an inquiry to make sure that you're a good credit risk and you are exactly who you say you are. So you're going to drop your credit score by about 5 points. But every month you make your payment on time as agreed upon, you will actually gain points. You will actually get over that. You will actually build your score beyond the 5 points that you dropped if you on a regular basis, after at least usually they say 6 to 9 months, make your payment on time, you will actually improve your credit score. The problem is that if every time you're offered, every month you're taking out a new line of credit and you're never giving your credit score time to recoup and recover that loss. So that's why you just want to be really careful about how often you're opening up new lines of credit. So you give your score time to recover that 5 point loss and even hopefully make it back and improve your score over time. Additionally, what can also hurt, and you will get more into this, is that if you have 25 lines of credit out, that can be seen also as high risk, because you could go out and charge up 25 different cards to the max limit in a couple of day period and walk away from it. And that is seen as a huge risk to creditors potentially. So how many lines of credit you have open can also impact it. So obtaining your credit report, each of the 3 credit bureaus, there's Equifax, Experian, and TransUnion. Those are the 3 credit bureaus. That is it. They will offer you what's called a FICO score. FICO, it stands for Fair Isaac Company Organization, I think, or Fair Isaac Credit Organization is what it was started by two guys by the last name of Fair and Isaac. And they see the Equifax, Experian, TransUnion, they have their own proprietary algorithm they use to calculate your individual score. But if you're an A credit in Equifax, you're more than likely going to be also an A credit in Experian and TransUnion. If that's not the case, if Experian is showing you as having an A credit, but TransUnion shows you having a C credit, then there's something that's showing up on one, not the other, and likely a mistake. And that's how you can kind of raise some red flags. Each of these credit bureaus actually have to provide you, upon request, a copy of your credit report. It's important to understand there's a difference between report and score. Report is all of the information that goes into calculating the score. So the report shows all your lines of credit, when they were open, when they were closed, how much debt you have on it. All of that is in your report. The information in your report is then put into their algorithm system and spits out a number. That's your score. Each of these 3 bureaus has a slightly different way of calculating the score, but what goes into it should be very similar. Okay. You can request a report from all three of these central sites, and you can go to annual credit report and request them from all three. Actually, asking for a copy of your credit report is not a bad idea, and is actually a pretty good way to also see if there's been any new activity. What we sometimes have some survivors do is every 4 months they request another report. So January they request Equifax's report. They wait 4 months, they request Experian's report. They wait 4 months and request TransUnion. So that can be a really good way also just to see any unusual activity is by getting a copy of your report. But do be careful about other misled websites. I think for a long time there was a cute little jingle, freecreditreport.com, and some funny commercials that were out for a while called freecreditreport.com. They did get shut down. Because what they were doing was they were offering you a copy of your credit report, but then you were getting a line of credit with them. So they were just giving you what they had to pull anyway to give you a line of credit. And so it was really predatory in nature, and people weren't really understanding, or they were also selling as part of that, they got credit protection, and people didn't know that's what they were getting. So that's why that you don't see those jingles anymore. That company got shut down. So just be careful. If you want to get all of them from one place, you can go to annualcreditreport.com and get all three of them there upon request. So it's important to understand what all is in your credit report. So personal identifying information, make sure you are who you say you are, name, birthday, address, social security number, employment. We'll get more into that. Credit history shows up in your credit report. So payment history, balance information, current status, public records, so bankruptcy filings, foreclosure and judgments and liens, as well as inquiries. So sort of what we talked about, if FISA asks for a credit reporter, who fits that, or if you went and tried to open a Target card, that will show in there as well. So all the inquiries that have been made. So let's unpack some of these and talk about what all is involved in each one of these factors. So some key factors that are in your credit score, the thing that makes the biggest difference is your payment history. So 35% approximately, and this is across the board for all of them, but approximately 35% of your score is calculated based on payment history. So that is so important that you get current and stay current if you can, as well as then the next thing that's important that is calculated is about 30% is on your amounts owed, and then 15% on length of credit. New types of credit and new credit and types of credit each make up about 10%. We'll go into some of these in more detail so you better understand it. So your credit score takes into consideration all of these categories, not just one or two. And it's actually impossible to say how important any single factor in your score is, since it's different for everybody. So let me give you an example that different debt is weighted differently. So has anybody ever heard the term good debt? Right? So people are, well, give me some examples of what good debt would be. Has anybody ever heard of that term? Anybody ever heard of the term good debt? All right, I'll go. Oh, nope, nobody's ever heard of it. Mortgage. Fantastic. Thanks, Jessica. So mortgage is a great example of good debt. So what the idea is that it is good debt because the debt itself has value. Right? So if I stop paying on your mortgage, they come get the house. So the debt itself has value. Same with your car. If you stop paying on your car loan, they come get the car. So the debt has value. You stop paying on your credit card, they don't come get what you bought with your credit card. So the debt is riskier and considered bad debt, or riskier debt. Right? So that is why on my credit score, a $200,000 home loan counts as much as potentially as $2,000 in credit card debt, because that home loan debt has value inherently in it. Auto loans are kind of somewhere in the middle, because that debt, that the asset holding against that debt is actually depreciating, versus my mortgage is appreciating. So that thing that I have debt on is actually gaining value as I pay on it. Whereas my car, I keep paying on it, but I'm losing value in the car too, because the car is depreciating, right? So those debts are weighted differently and count heavier or lighter on my score. And we'll get more into that. So I gave you the example of revolving debt. Credit card debt weighs heavier than something like a mortgage debt, because it has no value behind the debt itself. So the most important thing in calculating your credit score is on-time payments or payment history. So you want to make sure you make your payments on your debt on time. When I say debt, that's again, it's a reminder too that the only thing your credit score is taking a look at is how you're managing your debt, your borrowed money. Credit card, borrowed money. Mortgage, car, borrowed money. Your utility bill is not borrowed money. Your utility bill does not show up on your traditional FICO score, right? Because it's not debt. Now, if you don't pay it for a certain amount of time and they have a lien against you or they file a suit against you, it will show up as that. But you don't owe them. It's not like you borrowed money for a service and then you're paying that back. Your utility bills, your phone bill, trash, water, those kinds of things. It's not money owed as part of a debt, but it's a monthly service, if that makes sense. So that's not calculated into your traditional FICO score. Also, what shows up in this area is adverse or negative public records. So bankruptcies, judgments, suits, liens, wage attachments, collections, delinquencies that are past due show up in this area. Amount and number of past due or delinquent accounts or collection items, as well as length of delinquency. And then time since there was past due or adverse for any collections, and number of accounts paid as agreed upon. So not only what shows up in here is things that are past due or are negative, but also what shows up as the things that you are paying on time and that you are in good standing. So they kind of balance each other out. Hopefully you have way more good stuff than you have negative stuff in this area. Then the next thing that is about 30% of what your score is calculated on is amounts owed. And these are the numbers of accounts with balances. So amount owed on those accounts will also show up. And one of the things to keep in mind is portion of credit lines or your debt to limit ratio. And we'll actually cover a little bit more about what debt to limit ratio means in another slide here coming up. Then the next thing that is important on your credit score is length of credit history. So how long you've been using credit overall, but also how long you've been using a particular card. So if you have a Visa card that you've had in your wallet that you've had for 5 or 10 years, don't get rid of it. Having a couple lines of credit that you've had for a very long amount of time can be really beneficial in showing length of history with that credit card company. Things that make less of a difference are things like retail stores. So let's say you've got a Lowe's card. If you haven't used it in a long time, those don't count quite the same way, may not be advantageous to keep open like it would maybe a Discover or American Express or a Visa or something like that. So the newer the account, the more it hurts you. The older the account, the longer you've had, the better it helps you. So that's something to keep in mind. So the average of your overall accounts will also be calculated. The time since accounts were opened by specific type of account and time since there's been account activity is also on here. So you typically don't, particularly for like your Visa cards and your traditional credit cards, you don't want to go more than 6 months without usage on them. Now, what you can do is just go put a tank of gas on it or $20 and then pay it off, and then you're good to go for another 6 months if you're not carrying a balance. If you're carrying a balance, don't worry about it. It's still considered active. But if things ever get tight in the credit world, you can read the small print that credit card company has the right to close your account if there has been inactivity for 6 months or more. They have the right to. They don't always do it, but they have the right to. And they will do that if credit is tight, meaning that if they are concerned that there may be a mass use of credit if the economy crashes, people might go out and charge a whole bunch on a credit card. So they get worried about that. So they may implement that. We saw that when the economy crashed, 15 years ago, people started using their credit cards more because they were running out of money themselves. And so credit card companies started really implementing those as rules and shutting down credit cards. New credit also counts as one of the things that is calculated into your credit score. So the number of and time since recently owned accounts, as well as proportion of accounts that were recently opened, and the number and time since recent inquiries. So this is somebody inquiring about your credit score. So if you opened an account with Target, or you went to the bank to get a personal loan or a car loan, if you have multiples of those or how long it's been can count negatively. As well as reestablishment of positive credit history following past payment problems. So if maybe a year and a half ago you had a delinquent payment, but it's been a year and a half since that happened, that length of time is to your benefit. The longer you go since negative activity on your account, the better off you are. And then finally, types of credit used. So a mix and number of all credit accounts. So it will show what, if you have, 2 credit cards and an auto loan, or a mortgage and a revolving debt. And it'll show the types. Again, not all debt weighs the same. So keep that in mind. So understanding your credit score is based on all these categories, not just 1 or 2. All of these go into the mix in calculating that. The importance of any factor depends on your overall information on your report. So again, if I only have a bunch of credit card debt and I have no mortgage against it, and that's my only debt is a whole bunch of credit card debt, that's going to be pretty negative against me. But my credit card debt, if I have also then a mortgage or something of value, then that credit card debt is a little less weighty and negative against me. Information in your report changes, as does the importance of any factor. So as you pay off certain debt, other debt maybe becomes more important because you're paying down this debt. So it's all sort of a constant monthly algorithm that goes into that. Your score only considers your debt and how you've managed it. Again, your credit score is a score of debt and borrowed money. Again, credit card, borrowed money, and how you've managed it. Things like income, length of current employment, kind of credit you're requesting, and collateral. Those are things that lenders can consider and ask about, but are not a part of your credit score. So, the lender can ask you things like, how much money do you make? Your credit score doesn't know how much money you make, but the lender can certainly ask that, and often does, because they want to know, I see you have all this debt. Do you have income that supports that? They can ask for your length of employment, those kinds of things. If you want to borrow $200,000 on $100,000 house, they have a right to ask that. That's why they do inspections and things like that, and make sure that what you're purchasing equals the value of what they're lending. They don't want to give you a $200,000 loan for a $100,000 house, because if something happens, they can only recoup $100,000 out of that house, and they're still in the line. And then collateral you may have. Let's see here, one more here. There's a question here, loans for necessities to build credit. Yeah, we're going to talk about how you then can use loans to build your credit. So great question. Oops, over here. However, your report and your score do not include do not consider race, religion, sex, marital status, income, and age. Your credit score doesn't know if you're male or female. They don't know what faith you practice, if you do it all. They don't know your gender, if you're married. Any of those things are not in your credit report. So in some ways, it should be the great equalizer, right? Because it doesn't know those things. However, we know historically, certain folks have been cut out of lines of credit because of things like redlining and racism and all those things. So we know that historically, certain communities have been cut out of that, and that has certainly trickled down in their ability to access good credit now. But now your credit score, your credit report knows your date of birth as an identifier, but there's nothing negative or positive attached to you being too young or too old or whatever. It is only simply to identify you are who you say you are. Okay. So ways to improve your credit. Again, payment history. Pay your bills on time. If you've missed payments, try to get current and stay current. I think of credit scores kind of like I think of a GPA. When I went to college my freshman year, I had a fantastic time. I had a great time my freshman year, and I had a GPA that reflected it. I had the GPA that they give you for having a pulse, right? So then I spent the next, 3 years after a very, tersely worded letter from the dean suggesting I put a little more effort into things. I came back from that, but it took 1 semester to have a really sketchy GPA, and it took 3.5, maybe 4, 5 years to come back from that and build a GPA that I was happy with. So credit scores are kind of the same, that it can really just take one bad event to drop your score, but over time, the diligence you put into it, the work you put into it, and as time goes on with good things, you will come back from that. If you're having trouble making payments, contact your creditors. Ask them if they'll work out a plan with you. If you somehow you racked up a bunch of debt with Visa or a company or whatever, you can call them and say, look, I can't pay this off, or I can't pay based on what you're suggesting. Here's what I can do. Would you accept that? And see if they accept. The worst thing they can tell you is no, right? And also see a legitimate credit counselor. We'll talk more about how you find one of those in a future slide. The other thing to think about is keeping your balances low can help improve your credit score. So consider following the 30% rule. And I think I've got here we go. Here, this is the 30% rule. So this is example 1 here at the top. You have card A with a $500 balance with a $1,000 limit. You have card B with a $100 balance, $1,000 limit. Between the two of them, totaled up a $600 balance, $2,000 limit, I'm at 30% debt to limit ratio, which is good. Now, if I though then take my $100 that I got, I pay off card B and close it, then I am left with just 50% debt to ratio with card A, right? That's not good. So, but when I instead put that $100 towards card A and take that same $100, I am then now left, I've reduced my debt to limit ratio, which is good. The most ideal is that you have 30% debt to limit ratio in all of your cards, but overall is a really good place to start. So one of the things you want to calculate is your debt to limit ratio for all of your credit cards and make sure you are under your 30% debt to limit ratio. All right, let me go back to this slide real quick. Also, you want to try to pay off debt rather than moving around. This is the second biggest factor impacting your score. So really, it can be really tempting too, because you get some really great offers. And if maybe you get this great offer for 0% interest rate on a card, consider taking advantage of it, but look how long of a time limit you get to pay that off, or how long that good is offered for. If the offer is only good for 3 months, it's probably not worth moving money over there. It's going to take a month just to get that all settled. But if you're looking at something that's closer to 9 months or 12 months, come up with a plan. Only transfer over the amount you reasonably feel like you can pay off. Maybe you owe $5,000 on a pretty high interest credit card, and you get this offer for 0% financing for 12 months. But you can only pay off $1,000 of that over 12 months, then just move that over to that, because when that adjusts, it may go up much higher. So be aware. So improving your credit score, don't close unused cards as a short-term strategy. So if maybe you have a whole bunch of open cards available and you just go shut a bunch of them down, that can actually be considered a red flag and can actually hurt you. Closed unused cards can have a negative impact, especially if they're closed all at once, and depending on your overall debt to limit ratio. Again, too, you want to look at your debt to limit ratio and make sure you're not shutting down a card that you have been taking advantage of that's making that closer to that 30%. And then use cards with zero balance or activity at least once every 6 months so they don't go inactive. And we just chatted about that. I want to talk just a minute about shutting down cards though. So if you, after today, you're like, you know what, I'm going to pull out my wallet and see how many credit cards I have. I have 5 store cards and I have 4 major credit cards, and look at that. The ones you may want to consider shutting down first are your store cards that you don't use. If you've got a Sears card or a JCPenney's card or a store card and you have not used it in a long time, shut that down. Go ahead and shut down, but only shut down 1 card about every 3 months. You want to don't make it look like you're shutting down a whole bunch of things all at once. That can be a bit of a red flag. But maybe just shut down 1 card, wait 3 months, shut down another one, but start shortening your potential risk can be helpful. And don't open new cards you don't need just to increase your available credit. Maybe after today, you go through and you add up all your credit cards and you realize, whoosh, I'm at 50% debt to limit ratio. Let me take out a new line of credit to make that debt to limit ratio better. In the long run, you're far better off to try to pay down that debt instead of opening a new line of credit, because that new line of credit is also then potentially seen as more risk from the creditors. Also, something to keep in mind, again, we talked about length of credit. So if you've been managing credit for a short time, don't open new accounts too rapidly. So maybe you're just sort of getting back on your feet. You've got your head wrapped around this whole credit game. You want to work towards buying a house or something, and that's your goal, is to really improve your credit. Don't open up a whole bunch of new accounts at once. Open up one, manage it well, pay it on time, and then after 6 months or 9 months, you'll see the benefits of that, and then maybe consider opening up another line of credit to try to continue to build that. But really only open up new lines of credit as needed and as part of a plan. This will have a larger impact if you don't have a lot of credit. A lot of times in the credit industry, we hear terms like a thin file. Somebody has a thin credit file. That means they only have a couple of lines of credit, maybe 1 or 2. So that's a thin file. So any new line of credit will have greater impact because there's only 2 other lines of credit to balance it against. Versus me, I'm 50, I own a house, I have a couple kids, so I have a couple of cars and, a couple of credit cards and things like that. So me opening up a new line of credit doesn't have as big of an impact on my score because I have a whole bunch of other lines of credit balanced it out against. But if I only have one or two, a new line of credit's going to make a bigger deal because it's balanced against less. Does that make sense? I wish we were together so I could see your nodding heads and smiling faces, but I'm going to assume you're just on the edge of your seat and engaged. So that's awesome. Don't close old or inactive accounts that are in good standing unless there's a specific company or card you no longer use. Again, so, if you realize, I've had that Best Buy card for 5 years and I haven't used it, I don't see me using it, shut it down. Or I have an Old Navy account that I had a long time ago that I really just don't use. Shut those down. That's fine. But if you've had a Visa or American Express or a MasterCard, one of those major credit card companies for a long time, hang on to that. If they have a high interest rate, call them and negotiate a lower rate. You are certainly well within your rights to do that. And new credit, so rate shop. When seeking a new loan, don't be afraid to shop around for the best interest rates. Don't take whatever you're being offered from your dealership or from your bank. Do shop that around, and you can even do that through bankrate.com, I think, as we mentioned earlier. But do limit within a time period again. So if you're shopping for a car loan or a mortgage, you want to do that within that 14-day window period, so it doesn't count as multiple inquiries, it just counts as the one. And reestablish your credit. So opening a new account responsibly, again, paying it off every month on time will actually increase your score and can work to your benefit. Again, apply for and open new lines of credit only as needed. That's kind of a repeat. And then do so as part of a plan and with something long-term in mind. For example, if maybe I bought a house that needs some work done to it, that I need to boost it up a little bit. So I see that Home Depot is offering 0% financing and I want to put new cabinets in. Okay, that's part of my plan. I haven't opened a new line of credit in a while. So I go open a new, a Home Depot card. I buy my cabinets. I pay it off in the time frame that's 0% interest rate. That's a good idea. And then because I'm doing other home improvements that I might be able to take advantage of that. But don't open up new lines of credit just to save $2 at checkout. How many times have you been checking out somewhere in there and said, would you like to have an Old Navy card today and save 2% on your, that's not worth it. That's not part of a plan. So be really careful about just opening them up at checkout to save a few bucks. Question is, can you share tips on how to negotiate a lower interest rates? We'll talk about that, definitely. And if I forget, remind me. Use credit cards, but manage them responsibly. Having lines of credit and loans plus making timely payments will actually raise your score over time. And someone with actually no debt or credit or loans plus, someone with no debt or lines of credit is actually considered higher risk than someone who has managed credit responsibly. So you may have somebody that all they use is cash. They don't ever take out lines of credit. They are actually seen as higher risk because we don't know how they manage credit. Than somebody who has maybe multiple lines of debt, but they're only paying their minimum balance, but they're paying on time as agreed upon, is actually going to be seen by creditors as a better risk because they've proven themselves to pay at least on time. Okay, so closing account doesn't make it go away, so keep that in mind. A closed account will stay on your credit report. Opening up a new line of credit under a child's name is not a solution. It may actually result in damaging child's credit, and it's actually illegal and a form of identity theft. There has been multiple times we've heard stories of kids going to college and filling out college application FAFSA forms and finding out that they have ruined credit. Because a parent took out utilities in their name that they never knew about, and for good reason. And we certainly understand why a survivor is like, I got to get out of here. I got to get this new place, and the only way I can get utilities turned on here is because I have an old utility bill here is to put it in my kid's name. I get why it happens. Just know it can be really damaging, that what we should really focus on is how do we get a pot of money to help her pay off that old utility debt instead, and having those conversations. But to be aware that opening up lines of credit can in somebody else's name, particularly children, can be really damaging. And again, understand how to read your credit card statements. Pay attention to those statements. The minimum amount due, total due, due date, interest rates. If you're still sending checks, you make sure if the credit cards, the payments due on the 7th, that it's in the mail and postmarked no later than the 1st. You need at least 7 days in the mail. If you're sending stuff, if you're paying them electronically, give yourself 2 days to make sure that it all gets there, and make sure you're paying attention to that. Multiple lines of credit and loans plus making timely payments, we repeat this multiple times, will actually raise your score. So we'll talk more about what a good mix of that might be. So here's the different types of accounts that you might see on a credit statement. There's an installment account which has a balance, has a fixed monthly payment that includes interest. It is not closed. So an example of this would be when you go to get a home or an auto loan or a home loan. This is called an installment account. So you go buy a car for $20,000, you pay a set amount every month and you pay it off that same amount every month, and it is fixed. That interest rate that you got on the car loan when you bought the car is fixed for the lifetime of the loan, right? And once that loan is paid off, it will no longer build credit. So if you have a 5-year loan on your car, every month you're making your payment, you actually are building your credit score with your monthly payment. But once you're done paying the car off, you're no longer building credit because that loan is closed. Versus a revolving account. It doesn't need to have a balance or monthly payment. It does need to be utilized about every 6 months. And if the balance is paid in full every month, no interest will be charged. An example, this is your credit card. So your credit card is considered a revolving account. You can have a balance on it, you cannot have a balance on it. It's open no matter what. Even if when I get my Southwest Visa bill this month, I'll pay the total off. It will still remain open versus my car loan. If I go pay my car loan off, it's a closed loan account then at that point, right? So best practice is to, usually they say, have at least 3 active lines of credit. You wanted them to at least 1 to be an installment and at least 1 to be revolving. So an ideal mix would be at least 1 credit card and at least 1 installment account. So buying a car or something like that is considered to be the best. And then having a 3rd line of 1 of those 2 is what the industry considers to be the thing that can help you the most or be the most solid risk. So one of the questions here was share tips on how to negotiate a lower interest rate. Well, first of all, you should know your credit score before you're asking anybody to either lend you money or to reconsider the interest rate in which they're offering. Is that you need to know your score. If you know that, yep, when you took this card out, you didn't have a great score, you had a C credit score, but you've been working hard and you have a B now, or you have an A, that was one of the things you want to have in your back pocket. So you would just simply call them. And now the person answering the phone is not going to be emotionally involved in that that response, right? But you should know that, knowing that going in. So you call, you just say, I would like to request a lower interest rate, and that based on the fact, and it would be foolish to ask for it if your situation had deteriorated, unless what you were then offering is to close the account. So let me give you an example. If you had a pretty high interest rate on a credit card and you're running into tough times, you're having trouble paying it off, and you want to renegotiate the terms, you could call them and say, look, I'm having a struggle. I'm not going to be able to pay this. I want to close the account and just pay off the balance. And can we negotiate that? That's one thing. But if you have an active account, you want to keep it active, you just call and say, look, I think I deserve a better interest rate. I got an offer here potentially for lower interest rate. I'd rather not move if I didn't have to. I've been with you for 5 years, but I have a better offer here. Would you consider it? And they'll put that information into their algorithm and spit out an answer for you. So you just call, ask the question. The worst thing they can say is no, but it never hurts to call, particularly like on your Visa and your MasterCards and those kinds of things. Process for correcting errors in your credit report. There can be errors in your credit report. It's possible, particularly people with similar names. We've had often, if you have, this is just a heads up, this is a big challenge. If you have a lot of juniors, seniors, the 3rds and the 4ths in one household, those are really hard to differentiate. And so we see that a lot where there's lots of confusion on the credit score when you have people with similar names, but they're juniors and seniors, that those can get kind of wacky and mixed up on a credit report. So just something to keep in mind. So you always want to try to at least have a middle initial to be different if you are renaming somebody after someone else. You may need to collect evidence to dispute the error. So if you know you paid something on time, you have evidence of it, you've got something on your credit score, your bank statement, or anything that you have to show that that is an error. Reporting agency has 30 days to verify that information. So if you pull your credit report and you see that it shows that You never paid a JCPenney's bill from 5 years ago. You could show like, actually, here was my last statement that showed a zero balance, and that I want to dispute that. So when you click dispute on your credit score, because it's almost all electronic now, you click dispute, it actually comes off of your credit score. It no longer counts against you negatively. So you will have a temporarily, potentially falsely, but a temporarily elevated score, because that will no longer be counting against you negatively for the next 30 days. They have 30 days to prove that the debt is actually yours. If they can't prove it is yours, it will not come back on. And it is not uncommon for debt to not be able to be proven that actually was legitimate debt. A couple of reasons why. It may be so old or so small, it's not worth for them to do the research to prove that the debt is yours. And two, sometimes when they have sold debt to a third party for collections, you will find that oftentimes all the paperwork doesn't follow the debt, because they have to show that you agreed to the debt, that you had signature on it, all of those things. And if that whoever bought that package of debt didn't do their due diligence to collect all that, and they can't prove that it's yours, that it may not come back on. So when in doubt, question it. Make them prove that it is yours. If you know full well that that debt is yours, then don't waste the time. But if you're like, I don't remember, I'm going to challenge it, there's no problem. It doesn't negatively impact you. If the reporting agency is unable to verify that the entry is correct, then they have to keep that error off of your account. If the error is removed, you can ask that a correction version be sent to anyone who received that. So let's say you found out about this because you went to go apply for a new car loan, and you found out that you didn't have the credit score you thought you did, and you pull it and you find that there's an error on it, then you can request now and you were declined maybe the car loan because of it, you can request and they send a new one back to whoever was doing the inquiry and the corrected version. So when you want to get help, if you're unable to make your payments, contact your creditors as soon as possible, or contact a credit counseling service or reputable financial coaching counselor. And you can go and find these folks at the Fair Trade Commission, ftc.gov. And you can also go to the National Foundation for Credit Counseling, nfcc.org, to find a credit counselor near you. So something to just keep in mind when it comes to talking about fixing credit and using a third party to help you do it. The folks that are at the National Foundation for Credit Counseling are all worthy. They're all good folks. They've passed the test and all that stuff. They're certified to do that. And most of them don't charge. Most of them often will work through like a housing coalition or some sort of consumer credit counselor through the state's office. Be very leery of companies that advertise that for a fee, they guarantee an improved credit score. Here's what's happening in most of this, because you can't guarantee an improved credit score. You can't come to me and say, hey, my credit score is bad, help me no matter what, improve my score. I can't do that in a matter of 30 days, right? What they're doing oftentimes, if they're guaranteeing an improved credit score, they are simply challenging everything on your report. So that then the next time you pull it, it has a falsely elevated score because those things have to come off during the challenge. So they'll say, look, I improved it. I did what I said. Now, so then they get paid, but then all of those things are oftentimes coming back on your report when they prove that the debt is actually yours. So be very leery of those guarantees to improve your credit score because they are often predatory. And finally, we're going to get into just talking briefly about understanding bankruptcy. As many of you know, bankruptcy is a generalized term for a federal court procedure that helps consumers get rid of debts and repay their creditors. Bankruptcy, however, cannot clean up bad debt. It does stay in your credit report for up to 10 years. And things like spousal support, child support, student loans, and back taxes will never be discharged as part of a bankruptcy. So keep that in mind. There are essentially two types of bankruptcy that we most often hear about or talk about. Chapter 7 wipes out debts that allows for certain personal property exemptions. You would be able to keep a vehicle and keep your home, things like that. Chapter 13 is a court-approved repayment plan that is agreed upon reduced debt amount. So this is what probably most people end up using is a Chapter 13, where they go file and they have maybe $50,000 worth of debt, and they agree to pay $20,000 over the next 5 years or 10 years or 7 years, and they pay it to the court, and the court turns them to pay the people that are owed. And so that's what most people probably do as a Chapter 13. So before filing, just some things to think about is, can you free up funds to pay off debt? Have you talked to creditors? Have you talked to who you owe money to and ask them if they would, maybe you owe somebody $1,000. You say, look, I can't pay $1,000, but I can pay $500 and I can do it in this amount of time. So it never hurts to ask those questions. Also consider debt consolidation. Is there a possibility that you can take out a personal loan from your bank or borrow against a retirement account? Oftentimes you can borrow against your retirement account with little or no penalties or any other assets you have. Again, reach out to a credit counselor, the National Foundation for Credit Counselors, again, their website, or talk to a trusted attorney. I will just note that, you know, bankruptcies attorneys, that's what they do, right? So if somebody goes to see a bankruptcy attorney, they're probably going to end up filing for bankruptcy. It's like an old mentor of mine, Barbara Hart, used to say, if all you have is a hammer, everything starts looking like a nail. You know, that's what they're you go to them to figure out how to file for bankruptcy. But we actually had a program in Kentucky that they actually used some of their AllState Foundation funding to actually put an attorney on retainer and met with survivors who were considering filing for bankruptcy first. So that person was already paid by the organization. And every person that they sent to this bankruptcy attorney or this attorney, they found another solution other than filing for bankruptcy. I think that you would find that probably wouldn't be true if they were sent to a traditional bankruptcy attorney. So there may be other options available. However, I will say that for some people, it is the best thing that could possibly happen. Right. So I think we have to be really careful about any sort of judgment or sort of value we put on somebody if they file for bankruptcy. I have a dear friend who, you know, her husband was, you know, he's a Latin teacher. She was a not-for-profit attorney. They had significant student loan debt. They had all kinds of debt. And so they just couldn't get on top of it. And for years just struggled to get on top of things. And I think they figured out they paid their debt off more than 5 times. They were just paying all this interest rate they couldn't get out from under. Filing for bankruptcy was the best thing that happened for them. It got them level set. They came back from it. They ended up with a much better credit score in a matter of 2 to 3 years. They were able to buy a house. It was the best solution for them. So for lots of people, that is simply the case, in large part, because as we talked about in the beginning, many of us are not taught this information. We're making it up as we go. We're making mistakes as we go. And so I think a lot of it has to do with people are just doing the best that they can in tough times. And these are sometimes the results of that, right? So it is important to understand that, you know, the impact of bankruptcy could determine whether or not you get certain jobs. If access to a credit card or dealing with cash is involved, they may not allow you to have that job if you've had a bankruptcy. Your insurance could increase over time. It may be difficult to rent an apartment or qualify for an auto loan. Phone and utility providers may look at your credit history before providing service. And it's important to know that bankruptcies do stay in your credit report for up to 10 years. So just some things to think about. Again, no shade. For lots of people, it is the best result for the best way to get out of certain debt. So completely understand that. So we have made it to the end of module 3. And so we are poised here for a nice little break. I show that we're 25 past the hour. So let's go ahead and come back at 35 past the hour. No, 40. So we'll come back at 40 past. So that would be what, 10:40 your time. We will come back. Does that work, Teresa, for you?
Yes, sounds good.
All right, fantastic. So we're on break. We're going to come back. We're going to go sort of gangbusters through modules 4 and 5. They're a little bit quicker. We won't go into a whole lot of depth around some of those things. And then we'll wrap up sort of what you do with this now. How do you use this with the folks you work with? So with that, we'll take a break, get up, stretch, move around, and we'll see you in 15 minutes.